Welcome to Acacia Intelligence Cast, the Financial Deep Dive. Before we begin, a quick disclaimer. This audiocast is for entertainment and educational purposes only. It does not constitute financial advice and may be inaccurate, so do your own research. Now, let's get started with our expert fictitious panel, Priya Sharma, growth strategist, and Lin Chen, risk analyst. Today we're delving deeply into the numbers from NVIDIA's latest NQ. Let's start by comparing revenue performance across periods. We'll look at this quarter's revenue versus last quarter and the same quarter a year ago, and then break down each metric in detail.
Our analysis begins with revenue. This quarter, NVIDIA reported revenue of approximately $39.3 billion, a solid 12% increase from the previous quarter and an impressive 78% jump compared to the same quarter last year. This kind of growth reflects not only strong market demand, but also the rapid expansion in data center and AI-related business segments.
At the same time, we observe that the gross profit margin has experienced a modest contraction. While historical data place margins near 60%, current figures indicate a slight dip to around 73%. This change likely reflects increased production costs and strategic investments aimed at sustaining long-term growth. Despite the decline, the margin remains healthy for a company of this scale.
From today's reporting, market commentary underscores that while revenue numbers are robust, the tightening of margins is receiving close attention. Analysts note that this is primarily due to temporary cost pressures and ramped-up expenditures on next-generation technology.
Moving on to operating expenses, the report shows an increase of approximately 12%, mainly driven by higher research and development investments. These additional expenses are being funneled into creating advanced AI tools and next-generation data center solutions. Essentially, this spending is designed to secure the technological foundation for future earnings.
The cash flow statement is equally encouraging. Operational cash flow has strengthened considerably, which means NVIDIA not only grows top-line revenues but also converts a significant portion of its sales into usable cash. This robust conversion supports both reinvestment initiatives and provides a buffer against market uncertainties.
In terms of liquidity, the current ratio stands at about 2.1. This ratio indicates that NVIDIA has ample short-term assets to cover its liabilities, an important metric that reflects financial stability, especially in an environment where market conditions can sometimes be unpredictable.
Further, from a leverage perspective, NVIDIA maintains an impressively low debt-to-equity ratio around 0.16. This conservative capital structure is reassuring, as it means the company is less dependent on debt financing, reducing risk amid significant capital investments.
Another key performance indicator is the accounts receivable turnover ratio, which currently sits at approximately 2.2. This ratio shows us how efficiently the company is collecting revenue. While this figure is steady, there is always room to fine-tune collection efforts.
Lastly, return on equity has improved from previous periods, indicating that shareholders are starting to enjoy higher returns on their investments. This positive trend suggests that operational enhancements and efficiency improvements are translating directly into better profitability over time.
There you have it, a blueprint for analyzing companies. Remember to consult a financial advisor before making investment decisions. Until next time, keep your portfolios resilient and hope you enjoyed this entertaining audiocast that was purely AI generated.